Good afternoon and welcome to CRI's 2024 year-end tax planning for businesses. Appreciate you joining us today for the webinar on things your company can use to strategize, optimize, and maximize some of your tax planning ideas as 2024 comes to an end. Before we get too far into it, I want to cover a few housekeeping items. First, we will have these slides available for you. If you check your chat function of the Zoom platform, you'll see a link to download those slides. So if you would like to follow along on your own or have a copy to refer to later, please go ahead and download a copy of those slides at your convenience. Next is this session does not qualify for continuing professional education. So unfortunately, we won't be able to issue any CPE for this session. Lastly, people will remain on listen-only mode for the duration of the webinar. However, if you do have any questions, feel free to enter those questions into the Q&A section of the Zoom platform, and we will try to address those as they arise through that interface. Or if there's time permitting at the end, we may try and tackle a few questions at the end of the webinar. With that, I will introduce the presenters of today's session. First, Kelly Littleton is a partner in our Panama City office. She attended Spring Hill College and Florida State University. She enjoys high-intensity exercise classes, and she's looking forward to going to St. Lucia in the spring. At home, she likes to cuddle with Bentley, her Maltipoo. Also presenting today is Dan Shuey. He's a partner in our Tampa office. He attended Mansfield University. In his free time, he likes to play golf, and he also enjoys traveling to northern Pennsylvania. On the pet front, Dan has Max the cat and Bailey the black lab. And I am Chris Hoffman. I'm the tax service line leader of the firm. I got my bachelor's and master's degree from the University of Tennessee. I enjoy watching my hometown teams here in Nashville, the Tennessee Titans and the Predators. We frequently go on family vacations to the beaches at Hilton Head, South Carolina. And we've had a series of Boston Terriers, with our latest one being Dash. Now I'll run through our agenda for today. We're going to try and hit as many topics, fill this hour for you as much as we can. We're going to start out covering the Secure 2.0 Act, as well as the Inflation Reduction Act. We'll then transition into some business casualty loss rules that you may want to keep in mind. I know there's been a lot of hurricanes this year, so I wanted to make sure those loss rules were front and center in your mind. We'll then cover some of the IRS rules covering hobby losses before we go into some business tax credits that your company may want to evaluate. We'll then move into potential deferring income and accelerating deduction ideas that you could consider. And then we'll drill down into more specific business deductions that your company could take to help reduce your taxable income. We'll then go into estimated tax payments, things your company needs to keep in mind as it does cash flow planning. Before we wrap up the session with beneficial ownership information filing or BOI filing, we'll briefly cover that topic. And as I mentioned before, we will have, if there's any time left, we will take questions at the tail end. So with that, I will hand it off to Dan, who will begin the presentation.
Okay, thank you, Chris, and thank you everyone for attending today's webinar. I'll jump right into Secure 2.0 Act and give a little refresher on that. Just a quick fact about retirement plans. Only 1/3 of employees at small businesses have access to an employer-sponsored plan. Small businesses being 100 employees or less. So as we refresh on the Secure 2.0 Act and discuss some of the changes resulting from that act, we'll talk about some of the credits involved and tax incentives that came about from the Secure 2.0 Act. Some of these incentives came about a few years ago. Some are going into effect for 2024. So we'll just talk about that here and just so a brief summary on Secure 2.0. It's a law that made changes to retirement plans and IRAs. Enacted in December of 2022, the act aims at increasing retirement savings and participation among employees. The act expands on automatic enrollment programs, helping small employers sponsor plans for employees. And here are just a few provisions for 2024 and earlier that can have an impact on your business. So the first one being the pension plan startup cost tax credit. We'll just, look first, what's a qualified retirement plan in this case? This could include a defined contribution plan, like a 401k, a defined benefit plan, simple IRAs, simplified employee pension plans, SEPs, just to name a few. We always look to the eligible employers. This is for 100 or fewer employees with at least 5,000 in compensation per employee. Also, requirement is at least one non-highly compensated employee. And no prior year same employee plan requirement, which basically means that the employees generally cannot be substantially the same employees, for whom contributions were made under a plan of the same employer in the 3 tax years immediately before the first year to which the credit applies. Now, keep in mind, employer, we have to always look at the controlled group rules too, to determine if a member of a control group would be included in the employer definition. The amount of the credit, it'll depend on whether we're looking at 50 or fewer employees of the business or 51 to 100 employees. For 50 or fewer employees, basically is 100% of eligible startup costs up to 5,000 per year for the first 3 years. And then 51 to 100 employees is 50% of eligible startup costs up to 5,000 per year for the first 3 years. Now, there are other limitations in play. One being the max of the greater of $500 per year or the lesser of $250 per eligible, not highly compensated employee, or 5,000. So if you have one eligible participant employee in the plan, then you would still get the $500 credit because that's a max of greater of 500 or the lesser of those two. Eligible startup costs, we're looking at ordinary and necessary costs to set up and administer the plan, educating the employees about the plan, or what we're looking at there. And also credit cannot exceed the actual amount of startup expenses. And an owner-only business is unable to take advantage of the startup tax credit by adopting a solo 401k plan due to the highly compensated employee rules. And oftentimes the credit can fully offset the startup expenses to recoup the cost to set up the retirement plan, but this will depend on the plan type as well, since some plan types have lower administrative cost. For example, a simple IRA type plan may have lower administrative costs than, let's say, a 401k plan. You report this credit on Form A881. And a common theme you'll see across a lot of these credits are there's no double benefit. You cannot claim the deduction equal to the credit amount. And the next credit we'll go to is the employer contributions tax credit. This is another credit resulting from Secure 2.0. And to receive this credit, business must still meet the eligibility employer requirements described in the startup credit in the previous slide. This is for businesses with up to 100 employees. And this is a credit on employer matching or contributions or profit sharing contributions for the first 5 years of the plan. The max credit is $1,000 per year per employee. And then once you get up over 50 employees, the credit is reduced by 2% per employee over 50 employees. So once you hit 100, it phases out. This credit excludes employees earning more than $100,000 annually. And the first 5 years, there's a sliding scale on this credit. So years 1 and 2, the credit is basically 100%. When you get into year 3, 75%, year 4, 50%, and year 5, 25%. So once you hit year 6, basically there's no eligible credit available. And just an important note with this credit, it is based on the date the plan was established, not the date the employees began to participate. And also, you do not include employer elective deferrals and contributions to defined benefit plans when considering the credit calculation. Now, also note, employer contributions not eligible for the employer contributions tax credit may still be considered for tax deduction purposes. So if you can only use a partial amount of the match for the credit, then you'll be able to deduct the difference. This credit is also reported on Form 8881. And just a quick additional kind of credit note that doesn't have anything to do with this one. There is a military spouse retirement plan credit up to $500 per eligible participant that eligible businesses may want to consider as well. Okay, next we're going to talk about automatic enrollment tax credit. This is for eligible employers, same as the startup costs credit, that have an auto enrollment feature. This is for newer existing plans for simple IRAs, 401ks. And the amount of this credit is $500 per year for 3 years. And then on to automatic enrollment. One thing to consider moving forward and for new plans in 2025 and thereafter, employers will be required to automatically enroll eligible employees in their 401k and 403b plans. So that's fast approaching on January 1, 2025. So just keep this in mind. Now, employers are required to set aside a minimum of 3%, but no more than 10% of employee paychecks. And contributions increase 1% each year until a maximum of 10% of salaries reached, and that's capped at 15%. Now, the employee may elect out or elect to have different percentages contributed. And there are exceptions for newly formed businesses, which, operating less than 3 years, small businesses with 10 or fewer employees. For plans established before December 29th, 2022, this doesn't apply. And some government and church plans are also an exception to this. Now, one other quick note on automatic enrollment. These arrangements must allow employees to withdraw automatic contributions within 90 days of the first contribution without incurring the 10% penalty on early withdrawals. Also, employers must provide plan details to employees, including contribution rates, opt-out rules, and investment options. And moving ahead, there are 2 provisions of Secure 2.0 that went into effect for 2024, one being the starter 401k plan. Now, this may be a good fit for some small businesses. The drawback with this is there's lower contribution limits compared to other retirement plans, and no employer contributions, no testing. This is an opportunity for employers who do not currently sponsor a retirement plan. And like I said, this is deferral only. There's no employer contributions for these types of plans. It does have an automatic enrollment feature, And the deferral rate is 3 to 15% of comp, with a max contribution of 6,000 per employee, 7,000 for age 50 and older, and that'll be adjusted for inflation each year. There are annual notice requirements. Again, this goes into effect after December 31, 2023. The next provision is the matching student loan payment. And this is a provision designed to help employees balance saving for retirement while paying off student loans. And the key with this is employers may make payments to qualified plans that match the qualified student loan payments by the employees. And that is treated as an elective deferral for purposes of matching contribution. And that can be with 401ks, 403bs, 4057bs, or simple IRA plans. And this also goes into effect for 2024. So that's Secure 2.0. Let's talk a little bit about the Inflation Reduction Act. This act basically was signed into law in August of 2022. The law enhanced or created more than 20 tax incentives for clean energy and manufacturing. The act is a 10-year plan, so many changes won't happen immediately. And the IRS provides continuous updates and guidance with credit reporting changes, notices, proposed and final regulations, and frequently asked questions. So it's important to work with your tax advisor to understand these tax incentives on the qualifying factors and how and when they're reported. And you'll hear me say that quite a bit. These tax incentives can be complicated and difficult to navigate. So you want to work with your tax advisor. So here are just a few of the energy and fuel incentives that may have an impact on your business. The clean vehicle credit. This is formerly the new qualified plug-in electrical drive motor vehicle credit. It's a credit up to $7,500 that basically has critical mineral and battery component requirements. There are income and price limitations on this. Kind of the update with that credit is manufacturer phase out was eliminated. You saw this with the former credit where GM, Tesla, Toyota were subject to phase outs in 2022 once they sold 200,000 vehicles. Now, the previously owned clean vehicle credit, that's a credit lesser of $4,000 or 30% of the vehicle sale price. And this is just kind of just touching base on what these credits could look like. They all have different qualifying factors and eligibility requirements, but I'll just go kind of high level through each one. The qualified commercial clean vehicle credit, that's a credit potential of $7,500 to $40,000. We'll look a little bit in detail at that one later. The energy efficient home credit, that's a credit up to $5,000. The energy efficient commercial building deduction, that's for taxpayers that own or lease a commercial building, may deduct instead of capitalize and depreciate qualified energy efficient property. This could be like interior lighting, heating and cooling systems, insulation materials, windows and doors, just to name a few. And the property must be certified. The advanced manufacturing production credit. This is a credit for eligible components the taxpayer produces and sells, and it's based on different formulas depending on the component type. So whether it's solar, wind energy, etc. The clean hydrogen production credit, that's a 60 cents per kilogram of clean hydrogen produced per year, and is basically dependent upon how clean the hydrogen production facility is. And getting into the fuel tax credits, the biodiesel and renewable diesel fuel credit, that's a credit up to $1 per gallon of qualified mixture. As for fuel sold or used after 2021 and before 2025. And also taxpayers can claim a refund of excise taxes paid. The sustainable aviation fuel credit, that's a credit up to $1.7 per gallon of qualified mixture for fuel sold or used after 2022 and before 2025. And then we'll going to the next slide, just look at the commercial clean vehicle credit, just to kind of go into this in a little bit more detail, just so you can see how the credit works and how the eligibility requirements are determined. Now, first, we have to determine what the max credit is. It's $7,500 for qualifying vehicles less than 14,000 gross vehicle weight rating, and up to 40,000 for qualifying vehicles with a gross vehicle weight rating of 14,000 or more. So you're looking at anywhere from depending on the weight of the vehicle, could be 7,500 to 40,000. The actual credits determined vehicle by vehicle, and we have to look at the vehicle's investment, or your investment in the vehicle, the basis of that vehicle, and the incremental cost of that vehicle. And basically the credit amount is determined by taking the lesser of the two. And that could be a 15 to 30% of the vehicle's basis. The incremental costs, that's defined as the excess of the purchase price over a price comparable to a vehicle powered by gasoline or diesel. We also have to look at, okay, what are the qualifications of the vehicle in order to get this type of credit. Vehicles must be a clean plug-in electric vehicle subject to depreciation with a battery capacity of 7 to 15 kilowatt hours. There are no limits for income, MSRP price, or final assembly in the US requirements with this type of credit. This credit is reported on Form 8936. And if you're claiming this credit, you must reduce the depreciable basis of the vehicle by the amount of credit claimed. Another credit that came about from the Inflation Reduction Act is the research credit against payroll tax. This kind of goes hand in hand with the R&D credit that we'll talk about a little bit later. This is, with the Inflation Reduction Act, it modified some credits. This isn't related to energy, to basically help start up businesses with little to no taxable income. This is a $500,000 election amount to reduce, I should say up to a $500,000 election amount to reduce employer portion of FICA and Medicare taxes. It's basically $250,000 for the Social Security employer portion, and another $250,000 for the 1.45% Medicare employer portion of taxes. Qualified small businesses for this credit, current year gross receipts less than 5 million, and the business has to be less than 5 years old. Corporations, S corps, partnerships, and sole proprietorships can qualify. And for this credit, it kind of goes back to R&D credit. We have to look at the qualifying R&D, the research expenses. We have to look at the 4-part test, and we'll look at that later. That's basically a qualified purpose test, elimination of uncertainty, experimental and technical. But this is important credit, especially for startups, like I said, that, because of the income limits, that for startups that may not have a tax liability, this may be beneficial for them. And moving on to the next topic, business casualty losses. this, with being in the Tampa Bay area and dealing with 3 hurricanes from August to October, we thought it would be beneficial to discuss business casualty losses. So businesses have an understanding of the potential deduction if they sustain a casualty loss. First, we have to look to what is a qualifying event. This is property, damaged or destroyed by fire, storm, hurricanes, tornadoes, shipwreck, property taken by theft. That could include burglary, robbery, embezzlement. The lost property is most property held in a trade or business or that's entered into for profit. A few other notes on things we have to look at is property loss items must be computed separately. So an example of this, if you had a commercial building that was damaged from a hurricane, let's say, and you have the building, you have maybe some business vehicles in the parking lot, maybe you have some trees that fallen down. Basically, we have to look at each loss item separately and figure the loss separately on the building, on the business vehicles, and the trees to know how much of a loss to be able to deduct. And generally the loss is deductible in the year occurred. Exception is for federally disaster declared areas discussed later. The deduction's the lesser of the taxpayer's adjusted basis or the difference in fair market value before and after the casualty event. Now, if the property is totally destroyed and its fair market value immediately before the casualty is less than its adjusted basis, then the adjusted basis is the amount of the loss. That's an exception. The amount of loss is reduced by any insurance recovery and salvage value. And if you weren't sure or aren't sure whether part of your loss will be reimbursed, then you don't deduct that part until the tax year when you become reasonably certain that it won't be reimbursed. This later tax year is when your loss is sustained. And one other note on that, if you are reimbursed for a loss you deducted in an earlier year, then you include that reimbursement in your income in the year you receive it, but only to the extent the deduction reduced your tax in an earlier year. So let's just talk about the difference in fair market value before and after. This is important. A business owner may want to get a qualified appraisal of the business property. Note that a general decline in market value isn't part of the property's decrease in fair market value as a result of the casualty. Also, replacement costs can be used to determine fair market value before and after. You may be able to use the cost of repairs to the damaged property if the repairs are actually made. The repairs are necessary to restore the property to its condition immediately before the casualty. So be careful with upgrades in this case. The amount spent for repairs isn't excessive. The repairs only correct the damage caused by the casualty, and the value of the property after the repairs isn't, as a result of the repairs, more than the value of the property immediately before the casualty. So those are all things to consider when looking at replacement cost. Also, another note is expenses incidental to the casualty, such as, let's say, a rental of temporary space, and moving expenses are not deductible. And on to the next slide for special rules for federally declared disaster areas. And so, for example, with Hurricane Milton in Florida, pretty much every county in the state of Florida was just declared a federally declared disaster area. You can look to the FEMA.gov/disasters to see if an area would qualify. And what's important here with with these types of disaster losses is you can elect to deduct the entire loss in the tax year immediately before the disaster year. Now, the due date for this election is 6 months after the due date of the federal income tax return for the disaster year. And this can be, filed on an original return or an amended tax return. One note, if the casualty relates to a taxpayer's inventory and the election is made, then the taxpayer must reduce the opening balance of inventory for the actual disaster year, or the taxpayer would receive a double benefit of the deduction. Taxpayers may also revoke a prior year election within 90 days after the due date for making an election and must file an amended return. Also, taxpayers can file an amended return for a disaster year and then make a prior year election. It's just important to consider the timing of these elections, that they're made on a timely basis. There are some planning considerations when making the election to deduct the entire loss in the preceding year. Taxpayers may be able to obtain a refund more quickly. Taxpayers should look at tax brackets for the disaster and preceding years. Taxpayers may have casualty losses that could have an effect on casualty gains. Casualty losses and gains to business property held more than a year are combined under the capital gain and ordinary loss rules. So we have to be careful with that. And taxpayers should consider the effect of the disaster loss on net operating losses. And next, we'll discuss hobby losses. Every year, the subject of hobby losses is bound to come up during tax season. Here's just a general overview of hobby losses and reporting. Business owners must be able to substantiate the profit motive of their business to deduct losses. And behavior is often a determining factor of when we were talking about profit motive. The IRS can challenge the profit motive of business that generates losses and recharacterize those as hobby losses. And for 2018 through 2025, hobby losses are non-deductible due to the general suspension of miscellaneous itemized deductions. While hobby income will be recognized, no deductions will be available to offset that income, with the exception of cost of goods sold. Now, how can a business establish profit motive? There is a safe harbor test. To meet the safe harbor, an activity must generate a profit in at least 3 of the 5 years, 2 of the 7 years if the activity involves horse racing, breeding, training, or showing, ending with the year in question. If the safe harbor is met, the burden of proof for lack of profit motive is shifted to the IRS. The IRS can still rebut the profit motive presumption by proving that the activity is not engaged in for profit. Now, a business can use a facts and circumstance test to establish profit motive. One being, manner, is the activity conducted like a business? Expertise, does the taxpayer follow accepted business practices? Time and effort, does the taxpayer pursue the activity full-time or part-time? Does the taxpayer employ qualified people to perform the activity? History of income or loss, has the taxpayer made or expect to make a profit? Do any of the losses fall beyond the taxpayer's control? These are just a few facts and circumstances. And, one might be have more weight than another. Some planning ideas: maintain thorough books, keep business separate from personal, prepare a business plan, consult with experienced advisors and professionals, obtain necessary insurance, licenses, just to name a few. Again, you'll want to consult with your tax advisor to see if the hobby loss rules apply to you. And going over to the business tax credits, I know we've already talked about a few tax credits related to the Secure 2.0 Act and Inflation Reduction Act. We're just going to kind of give you a broad overview of the application and reporting of the tax credits and a few examples that may apply. A question that often comes up with business owners is what is the difference between a tax credit and a tax deduction? And how does the reporting of one versus the other affect the bottom line? So just keep in mind, tax credits reduce tax liability on a dollar-for-dollar basis, unlike deductions that reduce tax liability by the marginal tax rate. So if your effective tax rate is 20%, a deduction's worth 20 cents on the dollar versus a credit where you get 100% of that dollar. And basically, general business credits, when we're talking about tax credits, there's more than 30 tax credits that come into play here. The aggregate value may be limited and are reported on Form 3800. Each component credit is calculated separately and then carried to Form 3800. In general, unused tax credits can be carried back 1 year and carried forward 20 years. Passive activity and net income tax limits may limit the use of these credits for corporations, sole proprietors, partners, and S-corp shareholders. And generally speaking, the tax code does not permit taxpayers to claim both a credit and a deduction based on the same expenses. So just keep that in mind that a portion of the expense may be non-deductible if the credit's claimed. Section 196 also allows many lost tax credits to be claimed as a deduction. For example, a taxpayer that, may be able to claim a deduction year following that 20-year carry forward period, the year following after it expired. And then just really briefly, the research and development tax credit, that's a popular general business credit to incentivize business growth and provide cash savings. Credits available to qualified companies that incur qualified research expenses to provide information that would eliminate the uncertainty about the development or improvement of a product. This could be in industries of software, technology, aerospace, pharmaceuticals, just to name a few. The misconception is that R&D credits only apply to businesses conducting lab research, but could apply to many types of companies that perform a broad range of technical activities and work to develop or improve their product or process. Businesses must have qualified research expenses, wages, research wages, supplies, contract research, computer costs, and must meet the 4-part test for, permitted purpose, technical nature, eliminate uncertainty, where the ultimate solution is unclear before testing, process of experimentation, which could be, trial and error process. Record keeping and documentation is extremely important here. And this credit is reported on Forms 67, 65, and 3800. The research and development expenses, just one note that's important that could apply to a lot of different types of businesses for tax years beginning after December 31, 2021. Taxpayers must capitalize all R&D expenditures paid or incurred in connection with their trade or business. Prior to this December 31, 2021 period, businesses could immediately deduct research or experimental expenses. And these costs are amortized over a 5-year period. If it's foreign R&D, that's a 15-year period. The amortization of cost is required regardless of whether credit is taken. And the the expenses that qualify are more broad than the expenses that qualify underneath R&D tax credit. So you could have more costs that need to be capitalized and amortized than that qualify for the credit. And then just two really quick tax credits that we see often: employer paid FICA on tips. This is for food and beverage employers. The amount of credit is, for the portion of the FICA taxes the employer pays incurs on tips. That's 7.65% that exceed a 5.15 per hour minimum wage requirement. So if you pay employees over that amount, then you get the full 7.65% benefit. There's no double benefit, so we can't deduct the amount of FICA taxes where the credit is claimed. And then the Advanced Manufacturing Investment Credit. This was established by the CHIPS Act of 2022. This is a credit amount of 25% of qualified investment that is main purpose is the manufacturing of semiconductors or semiconductor manufacturing equipment. This is for qualified property placed in service after December 31, 2022. Property that is tangible, subject to depreciation, that's integral to the operations of that manufacturing facility. And it does not include the building or building functions for offices and administrative departments and so on. This credit's reported on Form 3468. And the taxpayer actually can elect to receive payments equal to the credit. This is for S corps and partnerships. And again, these tax credits can be difficult to navigate, so please consult with your tax advisor to see if your business can qualify. And I'm gonna shift things over to Kelly.
All right, thank you, Dan. We are going to look at some ways that you can defer income and accelerate your deductions as you're getting ready for the 2024 tax year. First, you want to make sure that you know what tax rate you're paying. If you're a C corporation, they have a flat 21% tax rate, and pass-through entities such as S corporations or partnerships, that income or loss flows through to the individual and is taxed at the individual level. If you have an opportunity to defer income into 2025, you want to do so. If you anticipate that your taxable income or your tax rate for 2024 will be higher, then definitely look at ways that you could defer income into 2025. You want to consider your method of accounting. If you file your tax return using the cash method of accounting instead of the accrual method, generally it puts the taxpayer in a better position to accelerate deductions and defer income, because you have more control over when that income is recognized. It's recognized when the cash is received, and when the expenses are paid is when you're able to deduct those. Most small to mid-sized businesses are cash basis taxpayers, regardless of the method of accounting that they use on their books internally. And the IRS has made this easier for businesses over the last few years to report their tax return on the cash basis. If you would like to change your method of accounting for tax purposes, there's a form that must be filed, and you must do so before the due date of the tax return, including extensions. Another way to possibly defer income is with an installment sale. Generally, a sale occurs upon the transfer of the property, and if there is a gain on the sale, then the income will be recognized when the payment is received. So if you are expecting to sell property before the end of 2024 and it makes economic sense, make sure you consult with your tax advisor. You may want to structure the sale so that it can be reported under the installment method, and there defer payment of receipt until 2025 or possibly even later years. The installment sale method does not apply to the sale of inventory, And if you have ordinary depreciation recapture, it doesn't apply to that piece of the sale either. So again, just definitely make sure you consult with your tax advisor. If you are on the accrual basis of accounting, make sure that you review your accounts receivable at the end of each year to see which ones are considered bad debts. As long as you're using a reasonable method and determining that a receivable is uncollectible, then you should write those off each year, and you will get a deduction for that bad debt in the year that it's written off and that you determine it's uncollectible. Also, if you're on the accrual basis of accounting, then you can accrue employee bonuses and go ahead and take that current year deduction, even though the bonus will be paid in the following year, as long as these certain criteria are met. The taxpayer cannot have a unilateral right to cancel the bonus at any time prior to the payment. The amount of the bonus must be fixed and determinable, and the bonus must be paid within 2.5 months after the employer's year end. We're going to look a little bit closer into some business deductions that you should make sure you're aware of for 2024. The qualified business income deduction, this came about with the TCJA in 2017. President Trump passed, that was his tax bill that passed. It is set to sunset at the end of 2025, but as we all know, we have a new president that has been elected, and we are anxiously awaiting to see what tax bills he may pass. You know, although we do have a Republican Senate and looks like we may have a Republican House, it took them a while to pass the TCJA, and we expect that it will take them a while to pass any new tax laws. But I know, as you know, Trump was running for office, he did mention that he would like to make some of the TCJA permanent. So we'll see. I'm interested to see what happens with this qualified business income deduction. This deduction was created to, you know, help partnerships and S corporations. They would receive a 20% deduction for their qualified business income to try to make them more in line with the C corporations that have that flat 21% tax rate. So many owners of sole proprietorships, partnerships, S corporations, and some trusts and estates may be eligible for this 20% qualified business income deduction. It allows eligible taxpayers to deduct up to 20% of their qualified business income, plus 20% of qualified real estate investment trust dividends, and qualified publicly traded partnership income. Again, income that's earned through a C corporation doesn't qualify, and also providing services as an employee is not eligible for this deduction. Excess business losses. Taxpayers other than C corporations are not allowed to deduct what the IRS considers an excess business loss. An excess business loss is the amount where the total deductions attributable to trades or businesses exceed the total income from those trades or businesses. For 2024, if you file married filing jointly, an excess business loss is considered in excess of $610,000, and all other taxpayers is $305,000. But that excess business loss is not lost. You can carry it forward as part of your NOL and hope to take it in the future. The net operating loss. If you expect to incur a net operating loss for 2024, the NOL can be carried forward indefinitely, but may not carry back the loss. And the rules have changed on NOLs in 2017. So if you have a loss coming forward that arose before 2018, those are deductible up to 100% of the taxpayer's taxable income. But if the loss arose after 2017, then those losses are limited to 80% of the current year taxable income. So if you're limited and not able to use all of that NOL, you can carry that forward to the future. Bonus depreciation, that's also a law in the TCJA that I'm hoping to see a change in, but we'll see what happens. It has been at 100% bonus depreciation. In 2023, it started phasing out, and it was 80%. In 2024, it's phasing out to 60%. and then it's supposed to go down and decrease to 0% by 2027. We do still have Section 179 depreciation, where you also can accelerate the depreciation, mostly on tangible assets. And for tax years beginning in 2024, the maximum 179 deduction is limited at $1.22 million. There is a limit, and it is reduced dollar for dollar by the amount of the cost of the Section 179 property that's placed in service during the tax year that exceeds $3,050,000. Definitely consult with your tax advisor on these deductions and what's best for you. Bonus depreciation can create a loss for your business, but Section 179 cannot. You are limited to your business income. Meals and entertainment. Business meals for 2024, they continue to be 50% deductible, while entertainment still is not deductible. If you are not already doing so, we recommend that you set up two chart of accounts, two expenses on your chart of accounts, one for meals and one for entertainment, just to help it simplify the accounting since they are treated differently for tax purposes. The exempt employee salary threshold had quite an increase in 2024. Exempt employees are those that perform certain duties, typically executive, administrative, or professional duties. On July 1st, 2024, the FLSA passed that the minimum salary threshold for those type of employees should be $43,888. And it's also set to increase again on January 1st, 2025 to $58,656 per year. So that is a 65% increase from where it has been, quite a big jump. So to prepare for that, employers should review their payroll and decide if they want to follow this and increase their employee's salary. If the salary is below the threshold, either you can raise it up to this amount or you need to reclassify that employee as a non-exempt employee. And then the non-exempt employees are subject to the minimum hourly wage, and you must pay them overtime. Home office deduction. If you use part of your home exclusively and regularly for conducting business, you may be able to deduct some of your home expenses for that square footage area of your house for the office. The home office deduction is available for homeowners and for renters, and it applies to all types of homes. You must be able to show that you use your home as your principal place of business and do not have another office to go to. Estimated tax payments. If you're a C corporation and you have taxable income less than $1 million, then you should pay your quarterly estimated tax payments based on 100% of your prior year's tax to avoid an underpayment penalty. If you're a larger corporation than that, then you should pay based on the current year tax. Generally, S corporations and partnerships don't make estimated tax payments to the IRS, but if they have made a pass-through entity tax election, they may need to make estimated tax payments to that state. So the state pass-through entity tax, many states have adopted an optional pass-through entity tax. This is for S corporations and partnerships to elect to pay tax at the entity level, and then it allows them to deduct that state tax at the entity level for federal tax purposes. And the owner then is not limited by the $10,000 federal cap for their itemized deductions. Many states then allow a credit or an income exclusion for the individual portion of the state income tax that was paid by the entity. Definitely want to consult with your tax advisor on this one to run an analysis and see if it's beneficial for you to make this election. And each state has slightly different rules and processes for electing, so you want to make sure you understand your specific state's rules. And finally, beneficial ownership information, or the BOI filing, is what everyone is talking about. Congress, passed this in 2021 in an attempt to, be more transparent, for owners to be more transparent with the governor, not with the governor, with the government, and just trying to reduce fraud and reduce financial crimes. But I think their intent was for FinCEN to set this up and have it going within 2 years. But FinCEN has pushed it quicker, and the filing deadline is January 1st, 2025. So we have seen where Congress has made a request to FinCEN and asked them to delay it to give business owners more time. So we'll see where that ends up. At this point, we do recommend that you follow the rules and follow the filing requirements. Again, this BOI filing is new for 2024, and certain entities must report information about their beneficial owners to the Financial Crimes Enforcement Network, also known as FinCEN. Beneficial owners are those that exercise substantial control over the reporting company, or that owns or controls at least 25% of the reporting company's ownership interests. The due dates for this filing, so for companies that existed before January 1st of 2024, this filing is due January 1st, 2025. For companies that were created during 2024, they have 90 days after they have formed to file. And then going forward, for companies created after January 1st, 2025, they only have 30 days to file. Also, if there's been any kind of change in the beneficial owner information, that is due to FinCEN within 30 days after the change. I have seen that there is a 6-month hurricane relief for certain victims. It looks like it applies only to new businesses, but if you are in a hurricane disaster area, check with FinCEN to see if you qualify for that extension. There is an exception to ownership reporting if a company qualifies as a large operating business. You must meet all 3 of these tests. You must employ more than 20 full-time employees that are based in the U.S., must maintain a physical office within the U.S., and you must have filed a federal income tax return in the prior year reporting more than $5 million of gross receipts. This $5 million threshold excludes any foreign source gross receipts. So while CRI is not filing this BOI filing for their clients, we have prepared frequently asked questions that is very helpful. If you want to jot down this link, or you'll have the slides tomorrow, we'll take a look at it. It does provide a lot of the information, who are the owners, what do you need to file, what are the due dates. There's not a fee for the filing, but if you do not file, there are penalties, including potential imprisonment. So it is important. We'll see what happens with Congress' request to delay the filing. And that's all I have.
Hey, thanks, Kelly. We are coming to top of the hour. I think we've been able to address any questions that have come in through the Q&A section of Zoom. So we don't have any outstanding questions at the moment. So looking at the time, we'll go ahead and start wrapping things up here. I first want to thank Dan and Kelly for taking a lot of time and effort in pulling together this presentation. And I want to thank them for doing this effort and getting this pulled together. If you like the information and want to stay in touch with any future changes that come across, I encourage you to connect with CRI on our various social media platforms. That'll get you any updates that we push out on our newsletters or any e-blasts that go out. Kind of try and stay in touch throughout the year rather than waiting to the end of the year to get these updates. So pick your favorite social media platform and connect with us. And last, I want to thank you, the attendees, for taking an hour out of your day today to attend this session. Hope it was helpful. Maybe plant some seeds in what you and your business need to be considering as 2024 wind down. If you do have any specific questions impacting your business, I encourage you to reach out to your local CRI advisor, who will be happy to help you interpret how this can impact your business. So with that, I will thank everyone and hope everyone has a great rest of your day.